HYBE's latest earnings call offered a revealing snapshot of how the K-pop powerhouse is recalibrating its global strategy in a post-pandemic touring boom while tightening its US operations and finally turning its fan platform business into a profit engine, signaling a maturing phase for a company that once relied heavily on a single flagship act but is now positioning itself as a diversified entertainment and tech hybrid. The most immediate headline was the restructuring of HYBE's American arm, a move framed not as a retreat from the world's largest music market but as a shift toward efficiency and clearer label autonomy. By consolidating overlapping functions, trimming costs, and redefining the roles of its U.S. imprints, the company aims to reduce operating losses that had weighed on margins since its aggressive acquisition spree, including talent management, distribution infrastructure, and partnerships designed to localize K-pop's business model for Western audiences. Executives emphasized that the restructuring would not slow artist development or global collaborations, but rather streamline decision-making and improve profitability, suggesting HYBE is transitioning from expansion mode to optimization, a typical cycle for multinational entertainment firms after rapid growth. The second major takeaway was the long-anticipated profitability of Weverse, HYBE's proprietary super app that blends community features, e-commerce, digital content, and ticketing into a single ecosystem. Once viewed as a costly tech experiment, Weverse has now crossed into the black thanks to higher merchandise conversion rates, paid membership tiers, exclusive media offerings, and its increasing role as the primary commerce hub for multiple labels beyond HYBE's own roster. This milestone is strategically significant because it validates HYBE's long-term thesis that owning the fan relationship, and the data that comes with it, can generate recurring revenue independent of album cycles, while also reducing reliance on third-party platforms that take a cut of sales and limit direct engagement. The platform's profitability also reflects broader industry trends in which fandom monetization, rather than pure streaming volume, is becoming the core financial driver for pop acts with global followings, and HYBE appears to be ahead of many competitors in building the infrastructure to capitalize on that shift. The third pillar of the earnings call was the explosive recovery of live events, with concerts and touring revenue surging to become one of the company's fastest-growing segments as international travel normalized and pent-up demand translated into sold-out arenas, dynamic pricing, and premium fan experiences. HYBE noted that multi-date stadium runs, VIP packages, and bundled merchandise offerings significantly boosted per capita spending, turning concerts into high-margin spectacles rather than mere promotional tools. This live performance boom not only strengthens cash flow but also feeds back into Weverse engagement and merchandise sales, creating a vertically integrated loop in which touring drives digital activity and digital platforms, in turn, enhance the concert experience through exclusive content, early ticket access, and community activation. Importantly, the company highlighted that revenue is now more evenly distributed across multiple artists and labels, reducing the concentration risk that once made earnings highly sensitive to the activity cycles of any single group. While legacy flagship acts remain powerful drivers, newer and mid-tier artists are contributing meaningfully to both recorded music and touring income, underscoring HYBE's success in building a multi-label portfolio that mirrors Western conglomerates. Financially, the call painted a picture of improving operating leverage, with cost controls in overseas markets, higher margins from direct-to-consumer sales, and the scaling of digital services offsetting fluctuations.